Welcome back to Sectors Made Simple, and it is very good to be back with you all. Today, I want to dive into the world of matrix strategies. These are something that kind of gets overlooked at times because it seems a little simple or too good to be true. Well, they are simple, and no, they're not too good to be true. Matrix strategies are one of the most incredible ways of learning the basics of not only investing, but a way to get your foot in the door when it comes to thinking about the stock market. It is not just a simple, it is simple, but it's not just a trust us, it works kind of deal. You actually get to see how these strategies think, why they choose what they choose, and how we can use these as part of our investment strategy. So today, we're going to dive deep into the world of matrix strategy. Starting off, quick disclaimer. I'm going to talk today a lot about matrix strategies, and all of them are based on historical returns. We did our best to find some of the highest performing and most consistent options out there when it comes to trading stocks, or rather ETFs. And because of that, it is based on historical results, and past results unfortunately cannot guarantee future performance, which is why it's very important that you trust but verify. Check out the real results that are up to date for yourself prior to making any investment decisions. Alrighty, the goal for today's webinar, and there's quite a few of them, so bear with me. We're going to dive into matrix strategies. We're going to talk about what they are, how we actually created these strategies, and of course, how to use the strategies. Then I want to go in and ask, or rather answer, some frequently asked questions that you all have been asking about and wondering when it comes to matrix strategies. Some examples include, how do we account or how do these strategies handle if the market is volatile or uncertain? Does it help if we set a trailing stop or an automated sell signal if the stock falls a certain amount? Or something as simple as, what types of accounts can you use a matrix strategy in? And of course, why do some strategies have negative returns? Well, we always hope that our strategy is to offer positive returns and the returns are outperforming the S&P 500. Sometimes that might not be the case, and I want to talk about why we might want to show you information that's not perfect. So, this is a lot of stuff, and we're going to dive into this all in a decent bit of detail. So usually I have a summary at the end of the webinar. Today, we're going to mix things up a little bit because it's fun and it keeps things fresh. But also, I want your mind to be fresh. So before we start to actually go through all the detail, here's a quick summary of everything that we're covering today. So if you just want the nitty-gritty, here it is. Matrix strategies are recipes for using Sectors Made Simple to find investments. It is quite literally step 1, step 2, step 3. That's as simple as it is. There's no learning how to study a chart. There's no learning how to look for different signals or what the best time period is. All right there in plain black and white text. Which means they're extremely beginner friendly. These strategies are awesome for anybody that is just getting started with investing and wants to take control of their own investments. And because of that, these strategies only trade one thing once a week, and that's it. So it'll buy one sector, hold that one sector until next week, and then see what the new thing is and sell it. Kind of like most teenagers with their cell phones, right? Now, here's the really cool thing. You can follow the steps and follow the recipe yourself. We do provide you with all of the knowledge needed to trade these strategies and see what sector each strategy is choosing for yourself. But we wanted to make that even simpler. So you can follow the steps yourself, or set an alert. So when a strategy updates what it's holding, you get notified via email. Now, these strategies can be used in any investment account, with a few small exceptions. One of them is cash accounts. So if you have a 401k, for example, or a brokerage account that is a cash account, it does add another level of not challenge. I know it says challenge there, but it adds just one extra thing we need to think about that we wouldn't need to think about if we're trading in a normal brokerage account or an individual retirement account, IRA. So in reality, as long as your broker allows you to trade sector ETFs, which most 401k programs do, then these matrix strategies can offer you a great choice. Also, and I put this one in bold because this was huge. Don't overthink the strategies. I have my own stories. I will share some of those stories later. Don't overthink the strategies. That's it. Trying to set trailing stops, trying to adjust for market volatility, or trying to use AI to improve on these strategies. First off, they take away from why these strategies are amazing in the first place, which is they're easy. They're easy to learn, they're easy to use. But also, it doesn't give you better results. I'll show you later on some studies that we've done that show that sometimes the simplest solution is the best one. And for these matrix strategies, that is 100% the case. So that is a summary of what we're going to cover today. Let's now dive into this in more detail, starting off with what matrix strategies actually are. Like I just mentioned, they are recipes for trading sector ETFs. The ETFs that we look at are the State Street Spider ETFs. All of them begin with XL something. There's 11 of those, and then the 12th is SPY, SPY, for the S&P 500. Each strategy trades once per week on the same day each week. So a Wednesday strategy will trade every single Wednesday. And what they do is that they look at the sector summary page, both the matrix and momentum. Quick refresher, the sector matrix tells us which sectors have the highest relative strength today. Momentum tells us what sectors have gained or lost that relative strength over time. So one is a picture of who are the leaders today. The other is a picture of who might be the leaders in the future, or who were the leaders in the past as well. Every strategy will use this one page, the sector summary page, to choose one sector. Every week, it will only choose a single ETF to hold for the upcoming 5 days in the market, or the upcoming week. So that's really about it. Next week, once the strategy reaches its trading day again, what we call the rebalance date, it will go in, repeat that recipe, and buy whatever that new sector is. To do that, all it's going to do is sell what it was holding last week and buys the new thing. That is really all it is. They're simple sets of rules that we've created a robot that can go out and follow those rules and provides you and me with not only the knowledge of what it's holding, but how well it's done as in addition. Now, these strategies came from somewhere. And in fact, we didn't just plug this into AI and said, go. We did try that, and in fact, it was significantly worse than even the lowest performing matrix strategy. Instead, Our goal was to create easy to follow trading strategies that aren't a magic box that spits out an answer at the end of every week. We wanted you to be able to follow these steps yourself because we want you to trust but verify. Trust the results that the strategy shows, but verify what it's holding and why. As our tools have grown, so have our strategies. The first matrix strategy dates back to 2020, only a few months after Sectors Made Simple was formed. And since then, we have grown for both our tools, but also our way to create these strategies. And the most recent round of strategies that we developed came from a group of over 30,000. We created and tested 30,000 or more than 30,000 strategies and picked 8. Now, these 8 strategies were not simply the ones that had the best returns. That was part of it. But we wanted to choose strategies based on a few different reasons. Total profit, of course. We want the thing to be making as much money as possible. But it shouldn't come at the cost of short-term profit. It's great to know that a strategy was profitable 3 years ago, but as I said earlier, past results do not guarantee future performance. So, to try and find strategies that are long-term strong performers and short-term strong performers, we also looked at their short-term 1-year profit as well. And the third thing is consistency. Again, we didn't want to find a strategy that made 20% in 1 month and lost 20% the next month. We wanted to find strategies that were the most consistent and offered a good blend of risk to reward. And lastly, this doesn't matter as much now as it did back then. We wanted to find strategies that traded on different days of the week. Originally, before we had the alerts, all of these strategies required you to go in and trade them on that rebalance date. And everyone's schedule is different. So we wanted to find strategies that traded on Monday, Tuesday, Wednesday, Thursday, Friday. And pretty quickly, Monday and Friday went out the door because the results were bad. So we have Tuesday, Wednesday, and Thursday. Monday and Friday, kind of have to forget about. So that is how these 8 strategies came to be. A lot of trial, a lot of discovery, and a lot of analysis. So we did all the hard work, so you get to enjoy the benefit. Now, I want you to know a few things about these strategies and about trading these strategies. First, it's possible that when the strategy decides to buy, there's no sector that meets its requirements. This can and honestly will happen. And in those weeks, the strategy will simply sell off what it was holding before and hold cash. It will buy nothing for that week and will wait until the following week to see if it's going to buy anything again. Also, the day of the week in the strategy's title is the rebalance day. This is the day of the week that the strategy trades. It trades during market hours. And our data, our matrix, updates once per day after market close. That's a little complex, but let me make it a little bit easier by just opening up the dashboard and sharing with you what I'm talking about. So if we open up the dashboard here, today is Tuesday, and the matrix was updated today. The market's already closed. It is currently 4:15 p.m. Pacific time. So the market's been closed for about 3 hours, and we have the data for Tuesday. If I check this tomorrow morning, Wednesday morning, it's still going to say Tuesday. And it will continue to say Tuesday and give you Tuesday's numbers until the market closes on Wednesday, and then the new matrix is created. Do you really need to care about that? No, but I do want you to know where those numbers are coming from. So if you see a Wednesday strategy, it's not using the Wednesday matrix. It's actually using Tuesdays, but it is trading on Wednesday. And then, obviously, these strategies only buy one sector per week. So we need to know what to do if two sectors tie. The way that we break a tie, two or more sectors actually, the way that we break a tie is to see which sector ETF had the best results, the best profits from the previous week. That would be the sector the strategy would buy. Let's quickly do an example. I'm going to look at the Wednesday long-term strategy. The name gives us a little bit of an idea of what it's doing and when. This strategy looks at long-term relative strength. We have short-term, long-term, and total. Total is long-term and short-term together. So this strategy wants to find sectors that have a long-term strength of 4 or more and a 1-week momentum of long-term strength of 1 or more. This strategy, again, is called the Wednesday strategy, meaning that it trades during the day on Wednesday using Tuesday's matrix. To follow these steps, if you wanted to do this yourself, we would sort the matrix by total count. Or sorry, this should be long-term strength, my apologies. And then, starting with the top sector, we would check to see if its long-term strength was 1 or more. That's it. If the long-term strength for the momentum is 1 or more, that would be the sector for the week. If not, we would then move on to the next sector in order of long-term strength. Let's try this together. So I'm going to pull up the matrix here. If you have your second monitor or if you have a phone available and want to follow along with me, I'll give you a couple of seconds to get situated on the dashboard. As a reminder, all of our tools are available on dash.sectorsmadesimple.com. If you only remember our actual website, you can find it under Resources, SMS Dashboard. Hopefully that gave you enough time. And as a quick reminder, if you are here with us live watching this webinar and you have questions for me about matrix strategies, please feel free to put them in the chat. I'm happy to answer your questions here as well. Alrighty. First thing I like to do when I'm manually trading or doing the strategy for myself is I go to Settings and I show Combined Matrix. You'll see why that's helpful in a minute. Now, this strategy uses momentum, 1-week momentum specifically. So here, where it says previous day, we're going to change this to 1 week ago. And it's going to use long-term strength, not total count. And we're simply going to click where it says long-term. So the biggest numbers are at the top, the smallest numbers are at the bottom. This strategy will only take a sector if its long-term strength is 4 or more. So we can highlight which sectors that applies to, which means there is no chance that this strategy would choose materials, XLB, real estate, XLRE, staples, XLP, or healthcare, XLV. So we now have our list of sectors from highest to lowest long-term strength, and we're going to choose the first sector in this list that has a long-term momentum of one or more for the 1 week momentum. And this is why the combined matrix is nice. All you have to do is look at this long-term, this triangle, which is delta long-term column. Let's start off with the highest long-term strength, technology. It's got a long-term momentum of 1. We're done. That's it. Strategy would buy technology. Let's pretend that it didn't have a long-term strength of 1. We would then check industrials, doesn't. Financials, doesn't. Healthcare, doesn't. Discretionary, doesn't. Communications, doesn't. Energy, does. So if technology, for example, didn't have any long-term momentum, then the strategy would have chosen energy. We can double check this too. If we go to strategies, we are trading the Wednesday long-term strategy, and we can see it's currently holding technology, XLK. We did it. That might seem like a lot at first, but the reality of it is, once you learn the basics of it, these strategies are incredibly, incredibly fast and easy to verify for yourself. But there are ways that we can save ourselves a little bit more time and a lot bit more effort. All of our strategies do show you how they choose their sector. We just walked through that together. So you can always follow these steps for yourself. But on the strategies page, there's also a ton of useful stuff for figuring out which strategy you might want to pick. We show you what strategy holdings are, so what sector the strategy is currently holding. In the case of our Wednesday long-term strategy, it's holding XLK technology. We also provide you with how well that strategy has done. So for example, we can go here and we can see that in the past 3 months, this strategy has had 10% gain compared to SPY's 5%. 6 month, it's up 6.6% to SPY's 2.3. 1 year, 9.56 to 10. And 3 year, 124 to 65. Double the returns of the S&P 500. And check this out. It doesn't only give you how well the strategy is done and how well it's done compared to the market, it also shows you a lot more, such as what's the worst it's done? How much did you have to risk by going into that strategy? 3 month, the worst you could have done. If you bought at the very top and you took every single loss possible, you would have lost, at worst, 4.34%. If you were in the S&P 500, you would have lost 7.6%. 3 year, 8% compared to SPY's 14%. 1 year, 11.4 to 14. So yes, the strategy had similar returns to the S&P 500, but had over 2% less risk. And then finally, for our 3 year, the risk of the strategy was 11.4. For SPY, 16. That's great and all. It's really nice to find what strategy you think is going to perform the best and to go through and do those steps every week. But what happens if you forget? What happens if you look at the wrong thing? You don't want to have to remember it's a Wednesday and then a Tuesday and the Tuesday and the Friday. No. It can be easier. Like, set an alert easier. Using the little bell icon in the top right of any strategy, you can set an alert for that strategy. So I could go here to the bell and say that I want to be notified or I want to get an email when the strategy updates what it's holding. So right now, mine is set up to get my email at the close of the previous trading day, which means for a Wednesday strategy, I would get the email Tuesday afternoon. And on the other screen here, I'm going to see if I can open up that email so that I can show you what that looks like and also tell you what time it gets delivered. Alrighty. Can I open this? Unfortunately, I can't open this to show off because it has my email and stuff in it. But today at 1:19 p.m., so 19 minutes after the market closed, I got an email saying that the Wednesday long-term strategy was updating and that the strategy would now be holding XLK technology. Here's a picture of what it would look like. That's all. You don't need to go in and do step 1, step 2, step 3, step 4 yourself. Step 1, find the strategy you want. Step 2, set your alert. Step 3, go enjoy the rest of your day. That's literally how easy it can be. These alerts can be sent the day before after the market closes, or if you prefer to do your trades in the morning, you can always have it email you before market open on the rebalance day. So a Wednesday strategy, you would get the day before email around 1:30 Pacific, 4:30 Eastern, or in the morning before market open on Wednesday. Now, you got the email also. Awesome, Francia. I'm glad. Which strategies do you have set up for the alerts? Because I'm crazy. I have all 8 strategies. So every day, well, I guess Monday, Tuesday, and Wednesday, I get spammed with all the emails of, hey, this strategy is updating, that strategy is updating. All of them? Yeah, that's what I like to hear. Awesome. Alrighty. So, I'm back. Where'd it go? There we go. Fernanda, I haven't received my email. Very strange. If you're not getting the emails, can you send me an email, please, to support@sectorsmadesimple.com? I'll see if I can help you out. Alrighty. Here's the thing. These matrix strategies are simple. It can literally just be this. You go open up the dashboard. The table's already sorted to show you the highest 3-month returns. Set an alert. Done. That could be the easiest way for a beginner to get started. You don't need to learn charting. You don't need to learn analysis. You don't need to learn anything beyond what a brokerage account is and how to use one and how to open one and what a sector ETF is. All of that you can learn over in our investment basics learning path on the Learn site. So again, if I wanted to introduce someone to investing, this is probably the way I would do it. It's simple, but it gets you involved in the market. But the beautiful thing about matrix strategies is that they can grow, and how you use them can grow as well. Do you need to? No, you really don't. Most of the value of the strategies is the fact that they're simple. And I'll be honest, I've tried many times to find ways to improve the strategies. What if we added BPI? What if we added a trailing stop? What if we added VIX? Every single time I've done that, the strategies have become a little bit more annoying to use and not as good. So there is one way that we can improve how these strategies work. So step one is that simple, straightforward thing. Choose one strategy and follow that strategy each week. The next step up would be go in and check how your strategy is doing. For months, months might be an understatement, for years, I was using the Thursday short-term strategy. Even today, with all of the ups and downs in the market, the strategy has returned 160.5% for the 3-year returns. This strategy we announced and showed off over a year ago, and it hasn't changed. And even the 1-year returns are still almost double the return of the S&P 500. But over the past 3 months, this strategy has been having a little bit of a tough time. Short-term strength has been changing a little bit too much. So if I wanted to change what strategy I'm using, I'd go here, sort by 3-month return. Oh, hey, this strategy looks pretty cool. I'm going to start using that one. That's the next step, is still just following one strategy, but every so often you go in and you ask them, hey, how you doing? Doing good? Doing not so good? All right, that's fine. That's fine. Throw it out the door and go find your new friend. We don't have to marry our strategies. We can choose whatever strategy we want or whatever strategies we want. So there's no reason that we can't get rid of a strategy that we feel like we could do better than and find a new strategy that we want to try out. So that's the next step. Checking every so often to see if there is a strategy that is doing better than the one we're currently in. And remember, past results. Still, past results, not perfect, but better than nothing. The third step, in my opinion, the last step really worth taking, is to look at all 8 strategies. Each strategy uses a slightly different way of thinking about the market. Instead of just taking one strategy and that's it, we can take all 8 and use them as opinions, where we take their ideas and then put them all together and figure out what we might want to do from there. Remember, matrix strategies are never a recommendation or a requirement. They are always opinions. These strategies are always going to continue thinking the way they're thinking, and their results will reflect how well they've done. So we can just look at one strategy or do something like this, where we say, how many strategies are holding technology? 1, 2, 3, 4, 5, 6 strategies. What are the other 2 holding? Communications and cash. All right. 6 out of the 8 strategies are all agreeing technology is the move. So level 1, find one strategy, stick with it. Level 2, find one strategy, and every so often, go in and see how well that strategy compares to all the others. In step 3, take all of the strategies and use their opinions to make your own informed decision. Now, let's dive into some Q&A. Before we do, though, I see one comment here. I like to check manually the strategies because it helps me understand moves and changes of sectors and how to find companies in the sector leader. Yes. Thank you. And that's the goal. That is the reason right there that we try and have these strategies be simple to follow and shows off how they think. Because the goal is that you can learn from them, that they are a resource, not a requirement. So thank you, Romulo. Yes, 100%. I love using the strategies as opinions, and then I make my own investment decision from that. Q&A time. First, do I adjust for a volatile market? If the stock market is all over the place and it's unpredictable, should I change how I look at these strategies? Or should I just not even use the strategies? From our analysis, and in my opinion, no, not at all. I did a full study and looked at all 8 strategies that we have on the dashboard, and I took their weekly trades from 2017 all the way up to today. Over 8 years of stock price and stock data. And I tried to see if we could profit more than the strategy if we only held cash if the VIX volatility is above a certain value. So if the VIX is above 25%, hold cash. Even if the strategy says buy technology, we would still hold cash. Would that give us better results? Not at all. For all 8 strategies, using VIX resulted in lower profits. And in most cases, it didn't just mean that we made less money, we also risked more to make that smaller amount. So let me actually show you all, because this was fascinating to me. I originally did this study because I wanted to show that volatility actually matters. And interestingly, the data showed the exact opposite. This is a lot of numbers, so if this means nothing to you, don't worry. The most important thing here is total return. The top total return is how well the strategy did. The bottom is if we traded or if we held cash if the VIX was above a certain number. In this version, I'm using 25%. So if the VIX is above 25, we would hold cash. I did this for every one of the strategies. And if the red boxes aren't a good enough clue, the majority of the time, you were worse off by following the VIX. In fact, VIX didn't matter at all. I tried to see if there was an average return for VIX, if the VIX was above or below a certain number, and the answer was no. On average, the market doesn't care what volatility is. The market's going to do what the market's going to do. And the reason for that is that volatility is forward-looking. It is 30-day volatility, but the market is reactive. If all of a sudden tariffs are announced and the stock market drops 10%, the volatility couldn't account for that. But the volatility is still going to spike right after it. So what can happen is that we get caught up in the craziness and the price goes down. And then we miss out on the recovery. Because the price goes down, and then at a certain point, it will come back up again. And we missed out on that recovery, on that come up again. So in reality, we're not avoiding any losses. And I highlighted one section of that analysis that I want to show you. If we go here to April 2022, is it? Bear with me. Okay. This period right here. From April 20th, 2022 to July 13th, 2022. What we find, the red over here means that we are above a VIX of 25. The week before the VIX went above 25, we lost 7.2%. Oh. Then the VIX went above 25, so we would have held cash. And, you know, it does kind of save us another 4%, But then we missed this. We missed 0.5%, 2.6%, 2.6%, 0.4%. Okay, the VIX is down again. Time to buy. You get hammered another 8%. So you sell out and you wait for the VIX to go down. Now you missed a 2.5, a 4.6, a 1%, and a 4.7% week. Trying to adjust for VIX sounds like a great idea. And the reason I did this analysis is I thought it was going to be a good idea. And the data says otherwise. That's the cool part about doing data analysis and why I love sharing stuff with you, sharing stuff like this with you all. You don't just find what works, you also find what doesn't work. So now we don't need to worry about VIX or if the volatility in the market is high or low. It doesn't matter. The best results are the simplest results. The second part of that question, though, should you sell at trailing stop? Should you go in and after you've bought your sector, say if it goes down 3% or 4% or 5%, sell? Answer, no. For the same reason that we probably don't want to care about volatility, we don't really want to care about a trailing stop. We did another analysis for this, and in that analysis, adding any trailing stop resulted in selling out too soon. The average change was about 25 to 30% lower profits because we put trailing stops on our investments. So we would sell out, realizing all the losses and not giving that stock or that sector an opportunity to recover. If you're interested to explore that data, I actually do have a version of that sheet that you can try out for yourself. I'll put it in the chat. But the way that you would use this is you would go in and you would paste your results right here. You'd paste the results and it would load. And here we see that using a 4% trailing stop was 1% worse, a 5%, 7% worse, 6%, and so on. Next question. When should I buy the new sector? Simple answer, don't overthink it. Don't overthink it. Anytime after the strategy is updated, you realistically can go in and trade. The strategy returns that you see on the dashboard, all of those percentages that we were looking at before, those are calculated using market close prices on the rebalance date. So this 6% was if you had gone in on Thursday right before market close and placed your order to buy. From our analysis, though, the most important part of the returns of a strategy is that you're using the right matrix. As long as you're using the right matrix, so for example, a Wednesday strategy would use Tuesday's matrix. As long as you're using Tuesday's matrix or just looking at the currently holding, you're probably going to be pretty well off. While market close on the rebalance date does offer, on average, the best returns, it's not the only way to profit from the strategies. In fact, you could buy 2 days after the rebalance date. So for a Wednesday strategy, you could have bought Friday morning and still have done better than if you just held SPY or cash. Again, I have a spreadsheet for that. A lot of this analysis that I share here is not meant to be trust me kind of stuff. This is all analysis that I have done to try and get to the bottom of how do we use these matrix strategies the best. And here we have it. For a strategy that rebalances on Wednesday, The blue line is if we traded on, or sorry, this strategy actually rebalances on Tuesdays, if I recall correctly. Let's see. January 6th, 2021. The reason that the start date matters, by the way, is that's the date that it rebalances on, Wednesdays. So if you decided that you wanted to trade on Wednesday afternoon, followed the as close to the returns of the strategy here as possible, you would be the blue line. If you bought, say you get the alert on Tuesday night for Wednesday strategy, and you place all your orders Tuesday night, you would be the yellow line. You get to the end of Wednesday, oh, you forgot to trade. What's it holding? Technology. Okay, place that order. Thursday, green line. Even Friday. Even if you traded on Friday morning, as long as you were still using the same steps and as long as you knew what it was currently holding, you could actually go in here and you would have the orange returns. It is still significantly better than the S&P 500. So it really does show that it's not this thin, razor thin line that you need to balance on, and falling to the left or to the right means the strategy is not going to work. If we know what it's currently holding and we are trading based on that, historical data shows that the strategies have performed well regardless of what time you buy. So if you work from 9 to 5, you can place your orders after hours or the morning of the next day or the next day and still enjoy the benefits of these strategies, as long as we're going off of the currently holding. Now, let's talk retirement. Can you trade a matrix strategy in an IRA or 401k, or really any account? The answer is yes, most of the time. Normal investment accounts and IRAs allow you to buy and sell sector ETFs without a problem. Most 401k plans also allow you to trade sector ETFs and index funds. But before doing so, please check with the company that you work for and have that 401k through, or contact that broker and double check. If your plan allows you to buy and sell sector ETFs, then yes, you can trade a matrix strategy in those accounts. But there's one important thing to know. It's called unsettled funds. And this doesn't matter as much now as it used to, but for retirement accounts, it still is important. When you sell a stock, you don't immediately get the money from selling that stock. So if I sold you $1,000 of Apple, I don't immediately get $1,000 to put in my wallet. I actually don't even get that money until the next day in what's called T+1. So the time that you buy the stock plus 1 day is when that trade would settle. So until that settlement, the money that I should be getting is considered unsettled funds. Most investment accounts, your brokerage account that you opened, or your IRA, they offer what's called limited margin. Margin, completely different. We're not talking about that. That's not, get that away. Limited margin is different. What limited margin is your broker knows that you just sold $1,000 of Apple. They are saying, we know that there's $1,000 coming to you tomorrow. We'll let you buy $1,000 worth of Tesla today. We'll lend you the $1,000, and tomorrow you just give us back the $1,000, no interest. So to get out of analogy world, most investment accounts, including IRAs, allow you to buy the new stock with unsettled funds. 401ks and any cash accounts. So if you do options trading and you're set up with a cash account, those do not allow for what are called good faith trades or trading with unsettled funds. So does that mean that if you have an IRA, a 401k or a cash account, matrix strategies are not an option? No, we just need to work around it a little bit. So let's do an example of both. With a limited margin account, which if you don't know if your account is cash or limited margin, answer, it's probably cash, unless it's a 401k. So with a limited margin account, the first week, we would buy $1,000 of whatever sector. I chose SPY. And in the second week, the strategy chooses discretionary, XLY. So I would go in and sell the $1,000 of SPY and get $1,000 of unsettled funds. I have a limited margin account. I immediately can go and buy XLY using the $1,000. No problem. So I can do my buy and my sell all at the same time on the same day. I can do it after hours even if I wanted. Cash account, slightly different. I would buy the $1,000 worth of SPY, and then the next week, before I could buy XLY, I would sell the $1,000 of SPY. I now have $1,000 of unsettled funds. I have to wait. The next day, the $1,000 have settled. I buy XLY. That's the only difference. The strategy still works. The only difference with a cash account is that you would need to wait until the funds have settled before you could use that money. Which again leads us into when should you buy the new sector? Anytime the strategy is updated. The returns you see are using market close prices on the rebalance date. And the most important part is again that you're using the correct matrix date. So while market close on rebalance has offered on average the best returns, it was still better to buy the sector 2 days late than not at all. And the last one. Why do some strategies show losses? Actually, I think there's 2 questions left here. Why do some strategies show losses? There's a few reasons for that. The first, once again, past results don't guarantee future performance. Just because a strategy was profitable and was successful when we put those strategies on the dashboard, it doesn't mean that that will continue. And we don't want to change these strategies every month. It's not right to. Our goal isn't to only show you the top performing strategies from last month, because that's going to change. Those are past results. I care more about a strategy like Wednesday long term. Actually, let's go to the Thursday long term. Return over the past 3 months is down 1%. But looking at the 1 year return, short term. There we go. The 1 year return for the Thursday short term strategy. These strategies we put on the dashboard 2 years ago. So seeing that this strategy is still returning 17.2% compared to SPY's 10% is a great sign, because that was future performance. These strategies will have their good days, their bad weeks, bad months, and so on. Our goal is not to show you the best things from last month, because there's no guarantee that they'll perform as well or better this month. Instead, our goal is to find strategies that are successful and consistent long term. And the second one is transparency. We very much want to talk about what doesn't work. Learning what doesn't work, just like with the analysis that I did with the, my apologies, the analysis that we did with the volatility, I went into that expecting and ready to see volatility matters, here's the magic number. And instead, I did all the analysis to find out that volatility doesn't matter. Learning what doesn't work is just as important as learning what does. So we want to highlight that any strategy will have good and bad periods. And it means that if we find that no strategy is beating SPY, or if the strategy isn't doing as well as we might want, we're not stuck with that. These strategies are only a small part of what you have access to within Sectors Made Simple. So if these strategies are underperforming, remember that diversification is huge. Don't put all your eggs in one basket is the common thing. A matrix strategy can, and in my opinion, should only be a part of your investments. The rest of it, or even if just matrix strategies are underperforming, that's very good to know, because then we can take a look at other tools and other strategies. We can find top performing companies with the S&P 500 screener. We can create a watch list of companies that might go on breakouts using the swing trade setups tool. There are so many ways that we can find investment opportunities beyond these strategies, and they don't take much to learn how to do. And again, if you're not looking for active investing, you're looking for that simple, see it, set it, forget it. Dividends. Look at Dividend Kings. Use a custom matrix to find which of those stocks is the best right now. There are so many ways to use Sectors Made Simple to simplify investing beyond just the matrix strategies. To learn more about what I'm talking about right now, I recommend checking out our Bear Market Investments webinar. I will post the link in chat right now, or if you're watching this recorded, it will be down in the resources section. So, once again, matrix strategies offer us a great, simple, straightforward way of learning to invest. It is active investing. You are trading every week. It is simple to follow because there's no analysis needed, but the possibilities of how we can use them are endless. You don't need to overcomplicate them, and in fact, overcomplicating them doesn't help. The simplest answer in this case is the best answer. So, these have been my answers for you. If you have any questions and want answers from me directly, please feel free to send me an email at support@sectorsmadesimple.com. Thank you all so much for joining me today. I hope to see you all back very soon. Take care. Bye.